I think it's opened up a lot of eyes of newer passive investors that real estate isn't free money. Yeah, it's a great way to build wealth long term, but it's not zero risk.
What's up, everybody? Mason McDonald and Dan Haverkost here with another great episode of the Big Picture Blueprint. And this episode was a ton of fun because the person we interviewed was actually the first real estate book that I bought the physical print version of. He authored it. So that's fun and exciting, although I took none of the advice from his book. But before we get into the introduction, Dan, how are you doing?
Yeah, I'm good, Mason. Enjoying January. Things are picking up. We're ramping up acquisitions as much as we can here. Got a new guy that started this week, so I'm busy.
Heck yeah. Yeah. Love to hear it. We're all retired early, but working more than ever. And that's business sometimes.
Yes, it is. All right. Well, today, guys, we have Jay Scott. Most of you probably recognize the name, but for those of you that don't, Jay is an entrepreneur, investor, advisor, author, and partner at Bar Down Investments, focused on buying and repositioning large multifamily properties. You've probably heard Jay on Bigger Pockets, but if you haven't, he's been in the business 15 years, and he's bought, built, sold, rehabbed, and lent on over $150 million in property all around the country. He holds advisor roles in several companies and is author of several Bigger Pockets books, including the best-selling book on estimating rehab costs. And then, most importantly, he is the co-host of the award-winning Drunk Real Estate podcast, which is an excellent show. I listen to that all the time. So let's bring him in and get this started.
All right, Mr. Jay Scott, it's great to have you on the show. How are you doing today?
I'm doing great. Thanks for having me, guys.
Yeah, we're excited to have you here. And with our first question, if you came over to my house and you saw that I had a nice looking, wine rack and I had a few bottles of Caymus, but I came out and brought out the Kirkland Pinot Noir, would you say this guy knows wine and he knows how to shop on a budget? Or would you say this guy's a jackass?
I would say I appreciate your taste in wine, both with the Kirkland and with the Caymus. And I would definitely hope you broke out the Caymus and save that Kirkland for yourself.
There you go. You can't beat the $9 bottle of Kirkland Pinot, but no, it would be me being a cheap bastard, which is not what my intention would be. But
so I drink a lot of wine, and a lot of my wine comes from Costco, as people who listen to my podcast know. So I have no issues against Costco wine.
Heck yeah, it's great. And the way I look at it, I'm a whiskey guy and a Scotch guy through and through. And shoot, if it's a $30 bottle that tastes great or a $3,000 bottle that tastes like crap, it doesn't matter. It's as long as you enjoy it in the comfort of your own home or someone's house. But awesome. Dan, well, I'll let you talk about, real stuff, because I could talk about wine and whiskey. And I'm drinking tea right now, if anyone cares, even though this is...
I just finished mine. I'm getting over this 2-week sickness, so I've been doing a lot of tea myself.
Gotcha. All right. Well, we're going to start with a big question here, Jay. So a few months ago, you posted about how China is issuing debt in American dollars, right? In USD, and kind of talking through how they're throwing their weight around, trying to have more control over the global currency markets. And this is something I think about constantly when I read a lot of history and the way that the country has increase the printing of our currency, right? We're not going to be the world reserve currency forever. You all talk about this on Drunk Real Estate from time to time. And sometimes it's one of those things where I don't know what to do, thinking the long term, being a millennial, having a long time horizon, hopefully with investing. My best guess is just buying solid assets. But I wanted to pose the question to you, since you post about this and talk about it a lot. How do you think about investing and managing your money with what's going on with China, with kind of the de-dollarization that's happening with the BRICS countries? How do you think about that, and what do you do correspondingly?
Yeah, it's both an interesting and an uninteresting, not to knock the question, but in many ways it's an uninteresting question, simply because we have so little control over it, that it really shouldn't be playing a large part in the investing decisions that we make. I think it's safe to say that like you said, at some point in future history, I guess future history a word? At some point in the future, yeah, the U.S. is going to lose the world's reserve currency. I don't say that because I think there's anything wrong with the U.S. or our currency, but it's just the way these global economic cycles play out over hundreds and even thousands of years. And so that's going to happen at some point. Do I think it's likely going to happen in the next decade, 2 decades, even 3 decades? It's possible. I'm not going to rule anything out, especially with the craziness we've seen just geopolitically and economically over the last few years. But I think that assuming we don't have any kind of economic black swan event, I think that the U.S. dollar is probably safe as the U.S. global currency for a good bit longer. If anything, I think the risk to global economic currency is that the U.S. dollar gets too strong. So there's a theory out there by a guy named Brent Johnson. He's a hedge fund manager, a very successful hedge fund manager, smart guy, who has talked about this thing called the dollar milkshake theory. And I hate the title because it doesn't really do it justice. But basically, his dollar milkshake theory is simply that because the U.S. controls currencies around the world, basically every currency on the planet for the most part is pegged to the US dollar. So interest rates are kind of, or exchange rates are kind of defined by us, not other countries. And because there's so much debt out there and all this debt is created in US dollars, when China does deals with Russia or Japan does deals with whoever, they're doing all these deals in the US dollar. Certainly they have some local currency stuff going on, but for the most part, when a country loans another country money or takes on debt from another country, they want that debt to be denominated in US dollars because they know that's the safest and most stable currency on the planet. And so for the most part, all debt in the world is done in US dollars, which means that all interest payments done in the world for the most part are made in US dollars, which means that every country in the world that has debt, which is pretty much every country in the world, has to make these interest payments. They have to make them in US dollars, and they're going to have this need for more and more US dollars over time because they're generating more debt and their interest payments are going up. And so all of this demand for the US dollar is likely to going to increase over the next few years. And demand for US dollars increases the strength of US dollars. It decreases the strength of other currencies. When we talk about the strength of the US dollars, just relative to other currencies, as the US dollar gets strong, other currencies get weak. People need US dollars, so there's a ton of liquidity demand for the US dollar. And now we have this cycle, this snowballing effect, where for every dollar that some country borrows, the US dollar is going to get stronger because they're going to have to pay more and more interest over time. And so over time, what we're likely to see, according to Brent Johnson, is the US dollar continuing to get stronger, every other currency on the planet continuing to get weaker until we hit a tipping point where basically every other currency on the planet is getting ready to basically collapse. And so his concern is that at some point, the US dollar is going to get so strong that it destroys the global currency markets because every other currency on the planet has now gotten so weak that these countries just can't survive with their currencies as they are. And the only thing that the US will be able to do at that point to avoid essentially an economic global meltdown is to restructure all of this global debt. Meaning we're going to have to make concessions to every other country on the planet to either forgive debt or restructure exchange rates or something like that, so that these countries can continue to exist. And I know it got a little bit complicated there, but long story short, for anybody that's worried about the U.S. dollar getting de-dollarized or getting taken away, the risk, I believe, is actually in the other direction where the US dollar gets too strong. And that's actually not going to be good for the US because if we have to restructure debt, if we have to make concessions to other countries to help their currencies survive, every dollar that we give to another country in concessions or debt forgiveness or restructuring is ultimately going to come out of our pockets. So I think that's actually the bigger threat to us.
Interesting. It's self-reinforcing then. As they take on more and more debt, they need more and more of the currency, simple supply and demand. That's fascinating to think about. It'll be interesting to see how that plays out in the coming decades.
Yeah, and to be honest, he made these predictions back in, I think, 2018, and what we've seen over the last 6 years is exactly what he's predicted would play out. And what we're seeing is the U.S. dollar continuing to get stronger and stronger, especially against some historically very strong alternative currencies around the world. And so far he's been right. Whether that's going to change or not, who knows? But it's an interesting theory and one I know a lot of economists are keeping their eye on.
Yeah, we'll both have to check that out and read into it. And I think that the strengthening of the U.S. dollar is just going to keep going up, especially if all of the tariffs that Trump is talking about are going to end up going through. And U.S. dollar will get even stronger. But I think it's good timing to talk a little bit about the change in administration. We're recording this episode on January 21st, the day after President Trump's inauguration. And of the couple of things he did on his first day office, couple being a light word for it, he declared an executive order for the emergency price relief on housing. Do you have any opinions or thoughts about that particular executive order and how that's going to impact us as, call us the mom and pop investors? You're probably a little bit closer to the institutional investor, as well as just the average American that's looking to buy a house.
So I think this unfortunately applies to a lot of the executive orders that were announced yesterday during Trump's first day. And don't get me wrong, I think that he is doing what he basically promised to do, which is take action on a whole bunch of things. But for the most part, a lot of these executive orders were performative. There's not much teeth there. The one that I think you're talking about, I forget exactly what it's called. I was reading it last night. But basically it was Trump demanding that all these executive agencies start lowering consumer prices. Basically what he said is figure out how to quote unquote lower the cost of living. Now, great. I'd love to lower the cost of living. But telling government agencies to figure out how to do that is not likely something that's going to just magically happen. So what do government agencies do to lower the cost of living? Well, one thing they can do is deregulation. And I think this is where we have a lot of opportunity. We talk about the housing market and the fact that housing is too expensive. Absolutely is. I think there's a lot more regulation in housing than what anybody wants. And I think deregulation in the housing market would go a long way towards reducing prices. Problem there is a lot of that is at the state level. A lot of what we're seeing in terms of regulation is zoning regulation and permitting regulation, insurance requirements, things like that are state level that executive branches aren't going to be able to step in and say, hey, California, you need to change your zoning and permitting processes to allow more affordable housing to be built. They can certainly encourage that. They can probably even strong arm state officials into starting to do more of that. Maybe they can be nice and work with state agencies to start doing that, provide some incentives. But at the end of the day, I think a lot of on the housing side, at least, the deregulation and the bringing down prices is going to come at the state level. With respect to things that aren't housing, I'm not sure that there's a whole lot that can be done, again, except in the case of deregulation, but we already have a good bit of deregulation in the consumer space. I guess you could do more regulation in certain areas where you actually force companies to modulate their profit margins. You can say, hey, we think the cost of appliances is too high, so therefore we're going to tell appliance manufacturers that you can't price gouge. And I hate that term price gouging because it's just capitalism. We companies set prices as high as they possibly can because that's their job. They're trying to make money for their shareholders. I don't believe it's the government's job to step in and say they can't do that, but if they did, that could potentially bring prices down. Lowering regulation is good because less regulation means more competition, but less regulation simply means that we're going to have more competition, which can take years to be implemented and to take place. So less regulation will achieve the same thing that more regulation will. It'll just take longer. Long story short, I know I'm talking in circles here because this is the first time I've gotten this question, because literally this just happened yesterday. But the short answer is that there's no teeth here. It's not quite clear what we're going to do to lower consumer prices. I'm not sure it's possible. If anything, I think the key is to keep prices from going up at this point any more than they have to, and at the same time encourage strong business performance and wage growth, so that while people are making more money and prices aren't going up, it feels like everybody's getting richer.
Yeah, I think you made a lot of good points there, and it's something that we experience in the land and new construction and development space, where President Trump talked about how during his administration, typical soft costs on a new single-family construction was $11,000, and now it's $50,000. And
Yep.
The challenge with that is that in the United States, every city, every county, pretty much in every single state has their own planning and zoning and development code, which is going to incur different costs across the board. So it's really frustrating where it's like, okay, well, I'm based in Colorado, Dan's in California, and it's very different in costs of, from permits to water tap fees and sewer tap fees or whatever it might be from every county within Colorado. And then you compare it to, California, you compare it to Florida or Texas and everything like that. And that's what kills so many development deals. And the idea to be able to say, okay, we're going to blanket this kind of across the United States and try and fix a lot of the soft costs associated with development through deregulation is really fantastic in theory. But it's also like, okay, well, you need to increase regulation, take a lot of this into the federal government's hand, which is, probably, yeah. I won't hop on a soapbox too often or too long about it. But I do think that the deregulation probably is going to come through a lot of incentives, probably like in the taxation, a lot of the, 2017 tax code that might be coming back, that sort of thing. So to try and pivot a little bit into the tactical, because we might end up, spending the whole hour just talking about what could be. Jay, what are your plans within your multifamily investing business going into 2025? Are you guys looking to start deploying more capital? Are you looking to do more deals? Or are you looking to kind of just hold and wait and see?
Yeah, I mean, we're always looking to deploy capital if there are good deals to deploy capital into. Unfortunately, over the last couple of years in the multifamily space, we've seen a good bit of turmoil. We've seen values drop 25 to 30% across the country, which just to make a comparison and put that into context, in 2008, when the single family market got crushed, we saw prices drop nationwide an average of about 21 or 22%. So essentially what we've seen in the multifamily space over the last 2.5 years since interest rates started to go up is worse than what we saw in the single family space back during the Great Recession. So it gives some context for anybody out there that's not in the multifamily space actively, what we've been dealing with the last couple of years. And it's not been fun. And unfortunately, it doesn't look like we're going to get a quick correction. I think a lot of people were hoping that we'd start the next part of the economic cycle, that expansion phase, where things start getting better and we start building and there's a lot of demand and cap rates start to compress. And unfortunately, it doesn't look like that's coming quickly. I think we've probably hit a bottom at this point. All signs are that we're probably pretty close to the bottom. Maybe there's a little bit more price discovery to go. And by that, I mean that there's so few transactions taking place right now that we don't really know even how much stuff is worth out there. Maybe it's worth less than what we think, just because if there were a lot of transactions, we'd see a lot of fire sales. But I expect we're probably pretty close to the bottom. I think things are going to get better over the next couple of years. Again, you want to buy low and sell high. So even though it feels like a really crappy time to be in this space, it feels crappy because prices are down, and that's a good time to be buying. And in this space, we typically hold for 3, 5, 7, even 10 years. If you think the market's going to get better in the next 3 to 10 years, which we do, now's a great time to be buying. So we are actively looking for deals. That said, we haven't done too much in the last couple of years. We put a good bit of our own capital into our deals, so we're not going to do a deal unless it's attractive enough for us to deploy our own capital in that deal alongside of our investors. And again, we just haven't seen a lot of that recently. Now, one of the trends that we're starting to see is that there's a good bit of development, especially in parts of the country, the Sun Belt, especially over the last couple of years. Even the Sun Belt this year is likely to see a good bit of development. But much of the rest of the country is going to see a slowdown in development over the next year or two. What we've seen is very few housing starts, meaning developers who have pulled permits and are actually ready to break ground or are breaking ground anytime in the next few months. And given that it takes a good 18 to 24 months to deploy new multifamily units, that means we're likely going to see supply start to dwindle over the next year or two. So what I do think is a good opportunity right now is new construction, especially in certain markets where we're continuing to see population growth, but we're not seeing a lot of new supply coming online in the next year or two. And so one of the things that we're starting to look at for the first time is some new construction projects, because we believe that there's some opportunity in certain locations. And then focusing again on those locations where we think that there's going to be dwindling supply over the next year or two. But again, continued demand, I expect that will drive rent growth in those areas. And assuming we don't see too much inflation and too much expense growth, there are going to be some areas of the country where we have some good opportunity over the next couple of years.
Yeah, no, that all makes sense. And it's a difficult dichotomy where when everybody wants to buy real estate and it's exciting, that's hard to buy anything at a reasonable price. And then when there's actually discounts out there, everyone's scared and you feel like the asset class is doomed. And so, I don't know much of anything about office, but I'm sure that there's some really competent people out there that know office that are getting buys right now that people are going to be very envious of a decade from now. It's just really scary, right? Because how much further is it going to go down? Am I going to be able to use this space ever? How do I, right? That's the irony, right? I've heard so many people saying, oh, I want to wait. But then when the time comes that you can get discounts, there are other reasons to wait, and mostly fear. So,
and this is one of the reasons I like multifamily. I mean, you take the office as an example, and yeah, there are a lot of people that are betting a lot of money on office right now, picking up stuff really cheap, and they are poised to make a ton of money, assuming that what we're seeing in office isn't a wholesale shift in demographics and use over the next 10 or 20 years. I mean, if we're really going to see work from home trends continue, if we're really going to see AI take over labor pools, so there are fewer people actually working jobs or working in offices, then it's possible that office is going to see a major shift over the next 5 or 10 years, and it really isn't a good investment. On the other hand, multifamily, you're going to be hard pressed to convince me that people aren't going to need a place to live in 5 or 10 years. Unless we see significant population decreases, which again, we could talk about potential for deportations and immigration law changes, which I think are the biggest risks there. But barring any major population risks, I don't think multifamily has the same risks as other asset classes in general. And it's one of the reasons why we like it.
Yep. Yeah, agreed. I bought a couple fourplexes last year, and Colorado has been struggling has been struggling with multifamily, but I figured that was a good thing for buying. Now, I do a lot of business in my land business, and Mason does some too in the Southeast. Are you, when you talk about some of these new development projects, looking down there or up in the Midwest where there isn't a lot of dirt left, or what parts of the country are you looking?
Yeah. So first and foremost, remember our customers are our tenants, and so the more potential customers we have, the better we're going to do. So we like population growth, and we're seeing a lot of population growth to the south and the east. So yes, we do like the south and the east. We still like Texas, or at least parts of Texas. We're seeing some good growth that continued into Texas. Other places where there are good tax laws So places where we don't have state income taxes tend to be good. Although Florida, where I live right now, I think is a horrendously bad place to be investing right now. And the Midwest, where again we tend to see less ballooning of prices. We see less appreciation, but we do see better cash flow. We see consistent growth, and we're still seeing population growth. I like the Midwest as well. In general, we're investing in red states. Don't get me wrong. I lived in San Francisco Bay Area for a decade, and most beautiful place I've ever lived, and can't wait to get back there at some point. I'd never invest there. Any states, and tends to be blue states where we have most tenant-friendly housing laws, are likely to get even worse over the next few years. We're seeing a lot of political divisiveness at the state level over the last few years. I think that'll continue. Blue states are going to get bluer, red states are going to get redder, and blue states are likely to get more tenant-friendly housing laws. Red states are likely to get more landlord-friendly housing laws. So regardless of where I might want to live, I definitely want to invest in places that are landlord-friendly.
Yeah, I'm the same way. I'm sitting here in San Diego. I love the weather, love the warmth, but I'm not buying rentals here. So,
yeah. Well, we experienced negative 30 wind chills yesterday, Dan. So we miss you out here in Colorado.
great, man.
So I want to draw back a little bit and talk about the past couple years. So, I got started only a little 3.5 years ago. Raising money was easy. Deals were flowing easier than, compared to obviously like it was on the tails of the pandemic boom that kind of occurred. Dan and I both, we're in land, we flip land primarily. Yeah. And for the sake of our own ego, we started a Reg D 506C fund to call ourselves fund managers. And it's been challenging raising funds over the past 1.5 years, give or take. We're still doing constant deals and everything, but it feels like the capital markets have been a little bit at a standstill. And so there's kind of two components of this question. We're, with Trump's appointment for the SEC, we're expecting potentially a little bit less regulation, maybe on the definition of accredited investors, on, being able to get paid for going out and raising money for people, who knows, who cares exactly, but we expect some deregulation. But also a lot of money's been sitting on the sidelines for a while now. You mentioned that you wouldn't do a deal unless you guys would put your own capital in. Do you feel like investors are chomping at the bit, ready to get back into the game in 2025? Or what have you kind of experienced the shift on the capital market side and the private investor side?
Yeah, it's exactly what you said. There's a lot of capital on the sidelines. The number I keep hearing bandied about, obviously nobody knows how much exactly, but $300 billion, somewhere in there. I'm hearing about the same amount of money on the tech side. I do some tech investing. So in a lot of cases, investors will move from one to the other in those asset classes. So probably somewhere from $300 to $600 billion sitting on the sidelines, which is a ridiculous amount of money. But the reason it's on the sidelines is because of two things. One, there aren't a lot of good deals out there. And two, investors are pretty wary. And so, yeah, it's convincing them that, one, they should be deploying into your deals, and two, convincing them to deploy enough capital that it actually makes sense. And we've definitely seen that over the last couple of years, that investors are very excited about doing deals or hearing about deals and talk about the fact that they really need to deploy capital. But then when you ask them to do that wire transfer, it suddenly there's a lot of hesitation. And I think it's simply because the market's been crazy. And I think a lot of LP investors, a lot of passive investors have seen operators who have historically done tremendously well start to suffer. And I think it's opened up a lot of eyes of newer passive investors that real estate isn't free money. Yeah, it's a great way to build wealth long term, but it's not zero risk. And for 15 years, I mean, basically 2010 to now, at least in the multifamily space, things have gone in one direction. It's been really hard to lose money. I mean, in retrospect, I haven't had to do due diligence on a single deal in 15 years as an LP investor. All I had to do was hand over my money, and then I got twice the amount of money back in 3 or 4 years, which was great. And we sort of started to lose perspective that, hey, deals sometimes lose money. And anybody that wasn't investing before 2010, 11, 12 may never have lost money before. And the first time they lost money on a deal, they were really upset because to them, it was like, this isn't supposed to happen. But the reality is it does happen. And so I think a lot of investors are now realizing I need to know what I'm doing before I continue to deploy capital, because there are risks that I didn't know about 2 years ago. And there are things that can happen that I didn't know about 2 years ago. And I'm realizing that I need to learn how to do due diligence that I didn't know how to do 2 years ago. And so investors are starting to become a lot more wary, and they want a lot more information, and they want a lot more diversification, and they want to make a lot of smaller investments into multiple operators and multiple types of deals and multiple locations and multiple exit strategies and multiple time frames. And so it's challenging. I do suspect that just like with everything else, as the market starts to improve and we get a little bit more exuberance in the market and people start feeling a little bit more optimistic, that the money will start to flow. But I think we still could be a year or 2 or 3 away from that. And I think it's going to be challenging times until then.
Yeah, I agree, and it's really been a weird economy because I mean, you go to Chick-fil-A. My wife and I go to Chick-fil-A, and it's like $30, and maybe we overeat, but I mean, it's ridiculously expensive. But
don't go to Five Guys.
Mm-hmm.
One order of fries is like $9.
Yeah, something like that.
It's absurd, and then I look at my stock portfolio because I invest heavily in the stock market. My stock portfolio looks fantastic. I know you've talked a little bit about a huge correction, which I probably see happening as well. But going into 2025, it feels like where Dan and I are pretty bullish. Obviously, in the land space, new construction is a huge component of that. We see a lot of opportunities for new construction in a good amount of markets throughout the United States, but I want to touch on one point that you made in a podcast you released a few weeks ago about data centers. I have some friends that are in the data, like in the actual, hammering construction of data center space. Why do you feel like that's one of the best places to be investing in 2025? And how do you go about investing in data centers?
Let me tackle the first question because the second one's probably a little bit more difficult and outside of my area of expertise. The reason why data centers are so attractive right now is that we're likely going to see a whole lot more of them over the next couple years. I mean, we all know where the technology trend is. It's in AI. And when it comes to AI, like most software technology, server space is obviously key, and data storage is key, and data centers are where we do that. And so big companies like Amazon and probably Google and Microsoft, they have their own data centers. They go out, they buy large swaths of land, and they build data centers, and you're not going to get their business. But then there are plenty of mid-sized companies out there that need significant data storage space. They need certain types of buildings and in areas that tend to be beneficial for data storage. One, you have to have good connectivity and good communications through fiber and good backbones. You want lower energy prices, so data centers tend to be very energy consuming. So areas where we can get cheaper electricity are going to be better in general for data centers. And so over the next couple of years, I think we're going to see a lot of companies that historically have outsourced their data needs to AWS through Amazon or through Google or these other companies that are going to realize we need enough storage that we're going to need to do this ourselves, but they're not going to want to go out, build a land development business and a construction business. They're not that big of a company. So they're going to go and they're going to find people like us, real estate investors, who buy and build data centers and then lease 1,000 square feet here, 10,000 square feet there for their servers. And so long way of saying there's going to be a lot of demand over the next couple of years. And us as real estate investors, if we can satisfy that demand, I think that we're going to see some great potential for return. Now, how do you get into that? Probably a little bit outside my area of expertise. I've actually done this on the technology side. I've never done it on the real estate side. So, again, I know what tech companies tend to look for, and they want places where labor is cheap, because a lot of times you have people sitting in those data centers not really doing skilled labor work. They're just monitoring servers, and they're making sure things aren't going down, and replacing hard drives when they break, and they're monitoring consoles and things like that. So you need decently cheap labor. You need decently cheap electricity. You want to be able to buy a lot of land, because, again, this land isn't being productive. It's just being used for storage. It's like warehouses, but really expensive warehouses. And then you want places that have good connectivity. Historically, places like Virginia, which has kind of the infrastructure of DC and Maryland, and all that government infrastructure, but 20, 30, 40 miles outside of the big metropolitan areas. So if you go into central Virginia or West Virginia, for example, that's been very popular. Places outside of like Phoenix. You've got that big metropolitan area that has great connectivity, great infrastructure, has all the power needs and redundancy that you need. But then you go 30 miles in any direction, and land is cheap enough that you can start building. So you get the benefits of the infrastructure and the labor force, but you get the lower cost of the land and construction. So if you think about places like that, places where we have a good bit of infrastructure and big MSAs, but where you can just go 30 miles in any direction and buy cheap land, those are the places where you're going to want to focus on for data centers.
Very interesting. Sounds like there's a lot of places in the Southeast that could fit that. So definitely a play there for land investors if you can find the end user. Wanted to do a big pivot here, Jay, and talk a bit about your investing, because I remember having listened to the business show and plenty of podcasts you've been on. I know you and your wife have your own portfolio of single family homes while you're also doing the larger apartment buildings. On a personal level, what are you doing to invest? Are you doing anything or just maintaining your portfolio? Any changes there?
Yeah, so I think at this point, have about 100 single family houses, and we've gotten smart about it. We don't deal with it anymore. Single family, to me, I love the single family asset class. I hate having to do the work in the single family asset class. It's very cumbersome as far as I'm concerned. You don't get the economies of scale that you get in multifamily, and much harder to manage, et cetera, et cetera. So what we've done is we found one or two partners that we really, really like, that live reasonable proximity to locations where we own a lot of single family, and we incentivize them to kind of run the deals for us and manage everything for us. We put in the money, we do some of the work, but they do the bulk of it, and we sit back and benefit. So for us, partnerships have been the greatest benefit for our single family stuff, and it's allowed us to continue to do a good number of flips and rentals every year, but without having to really get our hands dirty and take time away from what I like to be doing, which is the multifamily.
Sure. And we really want to talk through partnerships, but before getting into that, the single family often gets talked down about as if it's only for newbies. And I don't necessarily agree, because everything has its pros and cons. And I'll tell you, a nice single family home, the tenants you can get for that, it's very, very difficult to get that sort of tenant base in your 100-unit apartment building. So can you speak to why you've continued to invest in single family and why you like the asset class personally?
Yeah, I like it because it's highly liquid compared to multifamily. If I need to pay some bills, I'm not going to be able to sell a $20 million multifamily property where I have investors on a whim. I can't do it, one, because I'm not making decisions on my behalf. I'm making them on my investors' behalf, and they don't care if I have bills to pay. And two, anytime you're going to sell a $20 million or $30 or $50 million asset, it's going to take a good bit longer than to sell a $100,000 house. So one of the things I love about single family is liquidity. That liquidity also means that it's much easier to pivot if location ends up getting hammered for some reason, let's say bad weather events cause insurance prices to go up. And I'm not speaking hypothetically. I've owned a lot of single family in Florida that I've recently sold because we've seen a spike in insurance prices. It allows us to pivot very quickly. We can sell a bunch of single family again much faster than we can sell something large. Additionally, it allows you to scale at your own pace. So buying 100 or 200 or 500 units, it may take months and years to find good deals and to find investors and to find managers for something like that. But single family, if I want to add 1 or 2 this year, great. If I want to add 30 or 40 this year, great. If I want to scale down a little bit, great. If I want to scale down a lot, great. And so it just gives you flexibility on scale. So those are the big reasons: liquidity, the ability to pivot, and the ability to scale at your own pace.
Yeah, absolutely. I think sometimes the idea, I mean, you see all the book titles of 10x is easier than 1x or whatever. And it's like, well, you shouldn't worry about your 1,000th unit if you don't have one. So start somewhere where, it makes sense, where there's always going to be demand for it. But I do think that's a good opportunity to transition into partnerships where, you're able to have these 100-ish single family units and do all of this, with the podcasts and the books and the multifamily investing and everything, because you have effective partners. You mentioned that, for 15 years, you didn't have to do any due diligence on multifamily deals. You just, threw money at something and, got double it back in 3 to 4 years. But that's a lot different with choosing partners to work with.
Yeah.
What's your kind of due diligence whenever you're determining a new partner to work with? And then on that, for the current partners that you work with, what about them made them stand out for you to develop a long-standing business relationship with them?
Good questions. Okay, so how do I vet new partners? Number one, remember, you don't need to jump into a marriage tomorrow. You can start small with a partner, and that's actually what I like to do. Most partners that I have long term, we started on a single deal, or maybe even a half a deal, where they came in as like a 5% partner. I came in as a 5% partner, basically just so I could see how they work and I could see how they respond to issues and I can see how we deal with each other and all of that. So number one, start really small. And then grow from there, because I like to say that we equate partnerships and marriages. But if you think about it, if you go through a divorce, if you get married and go through a divorce, you're probably going to lose half of what you own. If you have a bad partnership, it's very possible that you can lose everything. So if anything, from a financial standpoint, take partnerships a lot more seriously than you would take a marriage. Number two is agreeing on vision. So I think a lot of people jump into partnerships without having the really hard discussion of, do we want the same things from this partnership? Do we want the same results? And it may just be, here's a crazy thing. I like this example because it's actually happened to me. Imagine you guys are talking about a partnership for the first time and you don't really know each other. And Mason, you say to Dan, okay, let's go do this. And you get into this partnership, and Mason, in your head, you're thinking, from this partnership, I want to make $1 million this year. Like, if I can make $1 million, this is successful. Dan, you haven't had this discussion, but in your head, you're thinking, oh, okay, if I can make $1 million, that's great for this month. I want to make 20 million for the year, though. What happens when you get 2 months into the year and you guys have made $1 million? Dan, you're thinking, great, this is a great start. Let's like hit the gas and keep going. Mason, you're sitting there thinking, shit, I just made my $1 million. Like, I only want $1 million for the year. I made $2 million in 2 months. I'm ready to go on vacation and take some time off. Now, suddenly, Dan, you're hitting the gas. Mason, you're ready to just like go on an all-inclusive for the next few months and start over again next year. And now it causes a lot of tension between the two of you because you had very different ideas of where you wanted this company to go. And so even something like that, what are your goals, are huge. And again, that was a real situation for me where, I've been in a situation where the person that I wanted to partner with had much, much bigger goals than I did. And so when they wanted me to be working 90 hours a week, I wasn't going to work 90 hours a week because I'm too old for that. Um, so you have to have those discussions. You also have to make sure when it comes to vision that you share the same kind of ethical and moral and outlook on life type stuff. One of the reasons why I get along so well with Ashley Wilson, who is my partner in the multifamily space, is for us, family is the most important thing. And we agree on that. And so she knows there are going to be days where something might come up and I'm going to say, hey, I have to take my kid to a soccer game. I'm going to miss this meeting. Oh, well, I'm going to miss the meeting. And my family's always going to come first. And I know same with her. There are going to be times where she's like, I can't go on this business trip because I have to take my kid to a dance. And I get that and I respect that and I'll never question that. And so having that shared vision and that shared kind of outlook on life is really important. The next thing I would say is deciding who's in charge. Can you realistically relinquish control to the other person or take control from the other person when you need to? Everybody likes 50-50 partnerships. In reality, 50-50 partnerships rarely work. I like to say that if you propose to me that we do a 50-50 partnership, that's enough information for me to know that we probably aren't going to work well in a partnership. That said, I mean, I'm okay with 50-50 as long as somebody steps up and says, it's 50-50, but I'm in charge here. And I have no problem if it's the other person that does it. In fact, I like it when the other person does that. But if somebody comes to me and says, hey, we're going to be 50-50 partners and we're going to make all these decisions together and it's all going to be democratic, the reality is you don't make democratic decisions with two people. You just have disagreements and nothing gets done. So again, in my business with Ashley, we're 50-50 partners financially, equitably, but at the end of the day, I said to her at the very beginning that she always is going to have veto power over pretty much, not everything, but pretty much everything in the business. And so we have this agreement that at the end of the day, if we disagree, there will never be a stalemate because she can always make the final decision. Despite the fact that we're 50-50, despite the fact that she trusts me explicitly, I trust her explicitly. And then the next thing I would say is don't get into a partnership with somebody unless you can work for them and you can manage them. Because there's going to be situations where you're going to have to treat your partner like an employee. You're in charge and they're taking direction. There's also going to be times when they're going to be in charge and you're taking direction. And so if you can't play both of those roles, if you're not comfortable basically relinquishing your ego and saying, hey, tell me what to do, and I'll follow directions. And at the same time, be able to say, hey, I'm going to tell you what to do and you need to be able to lead. If you can't take both roles with somebody when it comes to a partnership, then you're not ready to be in a partnership with that person. If you think, again, that everything's just going to be completely equal, it's not going to work. And then finally, I'll say that from a skill set standpoint, you two need to have very different sets of skills. I see too many people like meet up that they want to work together in real estate and they say, hey, you were an engineer, I was an engineer, you're an introvert, I'm an introvert, you hate raising capital, I hate raising capital, let's partner up and we're like the same person, let's do this. The reality is, yeah, that's great that you're the same person. Maybe you should go out and get a beer together and have fun together as friends, but as partners it's not going to work because all of your strengths, they have those same strengths. You don't need them. All of your weaknesses, they have the same weaknesses. They're not going to help you. You want somebody that has a completely different set of strengths than you have and a completely different set of weaknesses than you have, because at the end of the day, a partnership is greater than the sum of the whole, or the sum of the individuals. The whole is greater than the sum of the individuals. You want the two of you together to be a superhuman person. And for that, you need complementary skills. You need different skills. You need different weaknesses. You need different interests and desires and all of those things. And so make sure that the person you're partnering with isn't too much like you, because if they are, it's probably not going to work out.
Wow, that was fantastic. And I think that anyone listening, I mean, that's extremely relevant to business partnerships, but also employees that you're hiring, where I think a lot of people skip what so many people within business amount to the soft skills and the soft part of it, of the mission, vision, and values, and how important that is to have and work with people that are totally aligned on the mission, vision, values of the company, but also within incentives of it's very different working with, a 22-year-old that's hungry and going to cold call 100 hours a week as versus someone that's, financially secure and, ready for retirement. And then on the 50-50 partnership, it's really relevant to things that Dan and I are working on where it's challenging whenever there's no one quite in charge, where everyone has this equal decision-making power and equal authority. And I think that's actually something that my wife and I have been discussing. She's a co-owner in the company, and we had a conversation to like DTR, define the relationship a little bit of, hey, we need to have more effective delineation of roles. And I need to be able to function in the leadership capacity, and you're going to have to, be the employee. Although I can't use my CEO voice with her, I get in trouble for that, which kind of, brings me to my next point of for couples that are working together. What have you seen as extremely successful, skills and tactics to working with your significant other, and things that, put you in the doghouse?
Yeah. This has been a tough one for me. My wife and I partnered for 10 years, and it was at the beginning and even through the middle was relatively difficult because we were too similar. We weren't similar in terms of skill set. We weren't similar in terms of our ability to do things, but we were very similar in terms of mindset and personality. And we also had that relationship dynamic where I'm the husband. I don't want my wife to see me like be weak and like not be able to do something. And she was like, well, I want my husband to see me as a strong person who doesn't give in on stuff. And so you kind of had that relationship dynamic where you're acting a little bit different because you're also husband and wife or romantic partners, in addition to business partners. And so it got really difficult there for a while. The biggest thing that worked for us, and there were a lot of things, but the single biggest thing that worked for us was division of responsibilities. At the end of the day, being able to say, this is what you are absolutely amazing at. This is what I'm absolutely amazing at. When it comes to the stuff you're amazing at, and let's define it very specifically what stuff that is, you run the business, you run the show, you make the final decisions. I work for you. Whatever you need, you let me know. The stuff that I'm really good at, and again, let's define that very specifically. I run the show. I make the decisions. If we're hiring people, I do the hiring. If we're doing partnerships with other people, I make those decisions. You work for me. And then very clearly defining who runs what. And that worked really well for my wife and myself, because for the first couple of years, we kind of both wanted to do everything. We both wanted to make all the decisions. We both wanted to prove that like we were the one in charge. And this way we could both be the one in charge, but not of the same things. And so that was a huge mindset shift for us. And it very much, it's the way large corporations are run anyway. You have departments. You've got somebody who's the head of sales and somebody who's the head of marketing and somebody who's the head of engineering and somebody who's the head of QA and somebody who's the head of this and that. And they're not the same people. And so when we started to treat our business as having departments and she was the head of her department, I was the head of my departments, that kind of changed everything. And so just that mindset shift.
Yeah, I think that's fantastic and great advice that I wish, we had whenever she came into the business. And it was funny at my birthday party at the end of last year where one of my friends who's been, a serial entrepreneur for 30 years now was talking about the transition, and he's widowed and his wife used to work in the company too. And whenever his wife came into the company, he was like, well, how much do you want to know? How much do you want to be involved? And she was like, I want to know everything and be involved in everything. And then she did that for a few months and was like, actually, I changed my mind. That was too much. I don't necessarily need to see how all the sausage is made. This is what I'm good at. This is what I'm going to stick to. You're going to have decision-making authority. And then they created an agreement too, where they each got one veto per year on the other departments of whenever something came up, he would say, all right, or that she disagreed with of like, all right, do you want to use your veto? And she'd be like, actually, I trust you. And I'm not saying, that's the best advice on the planet or anything like that of giving one veto per year or anything. But I do think it's, you want ultimate transparency, you want total involvement. And what ends up happening is a lot of distraction or a lot of redundancy that leads to things not getting done. And that doesn't just happen with a spouse. It happens with the 50-50 partner, in business.
Yeah, 100%. And it's so funny because I, as partners with Ashley now, we're obviously not romantically intertwined. We're not married, but it's made me realize that men and women tend to look at things very differently. And so I've noticed a lot of similarities in just the way Ashley works as my wife and that partnership. And in retrospect, I think a lot of the things that I learned working with my wife for 10 years has helped me with Ashley. But more importantly, the stuff I've learned with Ashley, I wish I could go back and apply to working with my wife for the first 10 years. Because a lot of times we assume if we have an opposite gendered spouse or romantic partner, that the troubles we're having is simply because, like, I'm working with my spouse. In reality, a lot of that can just be that men and women and people in general, not just men and women, but people in general can be very different. But certainly in the business world, I found that men and women tend to be somewhat different in the way they approach things, if nothing else than just because the way they're conditioned. One of the things that specifically I've learned here is that Ashley is very cognizant of the fact that as a woman, she's often not taken seriously. I remember when I started working with her and she made that comment. I'm like, well, everybody takes you seriously. You're like literally the smartest person I know in this business. And she's like, oh yeah, just wait till we get into some meetings. And when I realized we go into a meeting, and even though we'd be talking about operations, for example, which is her area of expertise, I mean, she's written books on it, she's spoken on it nationally, and she's well respected. People are talking to me. And she's just kind of off to the side. And when I started really paying attention, it made me realize that, yeah, that's something that women have to deal with. It's something that my wife had tried to express to me for years, and I just kind of brushed it off because I didn't see it. And it finally, when it was not my wife, and it forced me to actually recognize it. So a lot of times what we think might be an issue between us and the spouse, it can just be a man and woman thing. And so be open to the fact that people are different.
Yeah. A lot of wisdom there. I'll probably go listen to that myself again. But anyways, I don't want to keep you too long. We're about to hit the top of the hour here. Jay, are there any questions that we didn't ask that we should have? Anything else on your mind pertaining to any of what we've talked about today that you want to comment on?
No, I think, again, we're in the end of January, and I think the next few months are going to be really interesting politically, legislatively, economically. It's so funny having these discussions like at the very beginning of a new administration, any administration, but especially this one when from an economic standpoint, I think things are kind of teetering and things can go in a couple different directions from here. And so it's always fun kind of prognosticating what's going to happen over the next few months or years. And maybe we'll do this again in a few months and come back and see how close we were.
Sure. Yeah, absolutely. And where can people find out more about you, your companies, what you're doing?
Yeah. jscott.com. So the letter J, SCOTT.com. That'll link you out to everywhere. I have a daily newsletter called DRE Daily, DREdaily.com for anybody that wants a daily economics newsletter. We have a great podcast called Drunk Real Estate with a couple of good friends of mine that we do every week. And if anybody wants any other information, again, jscott.com.
Yeah, Drunk Real Estate is excellent. I've listened to it quite a few times and definitely great for active investors in the market. But anyways, we'll link to everything in the show notes, guys. Until next time, this is the Big Picture Blueprint, Dan Haberkost and Mason McDonald, and we're signing off.